Want to know how a private equity fund lost $2 billion in the largest PE fund wipeout? This is a private equity fund structure. The fund raises equity at the fund level and then invests in companies, and they typically use debt to acquire these companies. But it's funded down here at the portfolio level, which is a great way to manage risk. It prevents bad deals from impacting good deals. But one energy-focused PE firm, Interverse Limited, which had a $2 billion fund, learned firsthand what happens when you apply leverage to a levered portfolio of investments. And unfortunately, the fund had two variables with the capacity to affect all of its investments simultaneously: the aforementioned debt and the price of oil. When the price of oil started to plummet in 2014, the firm began to realize losses that it just couldn't sustain. And per the Wall Street Journal, it may be the first time that a fund larger than $1 billion has lost essentially all of its value. Not great. If you invested in this fund, you probably only got pennies back for every dollar invested, if that. But here's what's wild. It's highly uncommon. At the time, only 7 PE funds greater than $1 billion had ever even lost money for investors, and losses greater than 25% are largely unheard of. But we have been living in a debt utopia for a long time now, and I'm quite curious to see how decades of growing leverage ratios will respond to a less accommodating Fed. It's going to get interesting.